Hi, everyone. I'm Elisabetta Bartoloni, partner at Hydrick & Struggles and leader of our global markets practice. Today, I have the pleasure of speaking with Joe Reece. And for those of you who don't know, Joe has a long career as an investment banker, first at Credit Suisse, then UBS, then as CEO of Helena Capital. And now he's the co-founder and managing partner of SilverBox Capital, an alternative investment manager operating across multiple platforms, including sponsoring a series of SPACs. Joe, it's great to see you. Thank you and welcome.
Elisabetta, thanks for having me. It's always a pleasure to spend time together.
That's great. So I'm curious, given your background as a banker, why did you decide to get involved with SPACs?
I get that question at least twice a day, maybe three. It's funny, when I think about capital markets over the past 20, 30 plus years that I've been involved, most markets have evolved. Capital markets are not static in the least. They are very dynamic. And I'll use an example of direct credit. Ares, Blackstone with GSO, Owl Rock, et cetera, Apollo, all have very large direct credit businesses. BlackRock, all who have disintermediated to a large part investment banks. You get to interact with very high quality investors directly as an issuer or a borrower. You get the ability to do syndicated loans directly without investment banks. Not to say that I want to disintermediate investment banks, I do not. However, when I look at the equity market, the equity issuance product, it's basically unchanged over that 30-year period. That credit, for example, has had a massive evolution. I think SPACs are the next evolution, and I think it's a better evolution for the IPO product. You can pick your investor base. You have a much more thoughtful interaction about valuation. You know who your anchor investors are day one. You can have better information into the market. So when I thought about what I wanted to do in the next step of my career, or the next evolution of my career, I thought there was nothing better for me and the team that we have built than to be a serial sponsor of SPACs.
That's very interesting. I'm sure it was a journey though. So I'm curious, so what are some of the lessons learned in starting a SPAC?
Well, I think the mistake a lot of people make, they think that you can do this, as one of my partners says, 2 or 3 men or women in a pickup truck or a computer in a garage. That's wrong. For us, as a serial sponsor, we're in the market now with our second SPAC. We've already finished one acquisition and we're getting ready to file a couple of others here in short order. This is a company that we're creating, and it is all about the component parts, the people involved. We have 10 core people. We have 30 people behind that: legal, accounting, corporate communications, IR, et cetera. To try and do this without a fulsome team with a different set of talents, we find it very difficult. You need 5 core competencies to be an effective SPAC sponsor, in our opinion. 1, you need to be able to source high quality companies. 2, you need to be able to diligence and effectuate a merger an acquisition transaction. 3, you need to know how to take companies public. 4, you need to support it in the aftermarket. And 5, you need to help provide managerial oversight, strategy, vision, guidance, partnership. That's all about talent. It is all about people. And our first SPAC, we weren't nearly as well staffed as we are today. And we just found through the process of targeting, acquiring, taking the company public, there are things that we as a sponsor wanted and needed. And more importantly, things that I think the market demands from an effective sponsor. So for us, it is all about talent.
Well, Joe, you raise a very interesting point that I'm not sure many people are focusing on, which is talent. So how did you put together your team, especially when it comes to combining both investment and operational expertise?
So what we did, Elisabetta, first we started with what areas do we want to apply capital, whether it's fintech, network computing, alternative energy, food, sustainability, consumer internet, et cetera. And then we tried to find the right people to fit those domains, whether it was on our advisory group, Dean Hollis, who ran Conagra, or Tom Warner, who's the recently retired CEO of SunPower, or Glenn Marino, who was at GE Capital and then the chief commercial officer at Synchrony. Network computing, SaaS, consumer internet, et cetera. We have Laura Sakar, who was the founder of Starvest in New York. So what we wanted to do was to make sure that we had the right people on the team to help us go deep in whatever domain that we wanted to apply capital to. On our core senior management team, Steve Cadenisi, my co-managing partner at SilverBox, ran a large technical services company, AECOM, in Los Angeles. Our CFO, Dan Esters, came out of a long banking background at Jefferies as our CFO. We have a CIO and a COO, Jin and Duncan, who both came out of Macquarie. So we wanted to put people in seats who had domain expertise or functional and technical expertise to fill one of those 5 things that I mentioned earlier, from sourcing to supporting a public company, as well as providing management talent and thought leadership. Because without the right team on the field as a SPAC sponsor, we just don't believe you can be competitive, either in raising capital or B, most importantly, putting it to work effectively. So for us, talent, the equation and the creation of the team is critical.
Well, Joe, I couldn't agree with you more. Clearly, as you know, that's what we do every day over here, is putting together the right and the best teams. So what specific skill sets, so if we spend a little bit more time on this, were you looking for when putting together your management team and the board of directors?
Well, the first skill is to be a sensible human with good judgment. What we're finding in this era of Zoom, there is no demarcation between personal time and professional time. We start at 5 and 6 a.m. and we finish at midnight. I miss the days when we got on a plane and traveled and could actually catch a breath now and then. So as it relates to how we picked our team, they needed to be a good fit, first of all, even before we thought about skills. We do spend a lot of time together. We are making investment decisions together. We are choosing investments together. We are supporting companies together. We are doing diligence together in a very challenging time. And again, we thought about the domain where they had an expertise. We thought about their particular areas of expertise, both functionally as well as from an industry perspective. And I'll use Laura Sakar as an example. She's on our board of directors. She's got exceptional insight into SaaS. She's got exceptional insight into consumer internet, compared to Glenn Marino, who's got exceptional insight into fintech and running a company, running Synchrony. Laura is a great investor. So we've got a great investor, we've got a great operator. They come at things differently, but they provide a great overlay of insight that helps me as the ultimately with Steve, the person responsible for putting that capital to work. Without their judgment, without their insight, it makes it virtually impossible for us to do what we do. Having them, we think, is a competitive advantage. We think having the judgment they bring, the experience they bring, the diversity of thought they bring, helps us as we try to effectuate those transactions. It's a competitive advantage. And we actually believe that having the right talent on your platform makes you a better investor. It will make us a better manager. It will enable us to do better deals and bring better companies to the market, which at the end of the day, that's my job, is to bring great companies to market that investors want to own.
So you talked about diversity, and I'm sure you know that there's a tremendous focus on corporate diversity and inclusion. However, in general, SPACs management teams and boards are not particularly diverse. So why do you think that's the case? And do you think, or do you see that there is an appetite across SPACs to pull together diverse teams for themselves and for their operating entities?
You know, it's a great question. And all too often we see diversity for diversity's sake.
Mm-hmm.
When you rely solely on an identity for your decision-making, it's not always great. I think, though, if you have diversity for real meaningful purposes, for example, we've got Joe Hurd on our board of directors. Joe happens to be a Black man. He also happens to be an exceptional executive who worked in the Obama administration, worked at Facebook, does a great deal in Silicon Valley right now as an angel, is extremely well connected, super bright, super thoughtful. We have Laura Sakar, as I mentioned. We didn't pick them because they were diverse. We picked them because they were exceptional professionals. And so when I think about where we are as a society on board and governance, it has been an evolution to be more diverse. I think the last 12 months has caused that evolution to slightly become a revolution, which I think will potentially yield really good result. Again, I don't think diversity for the sake of saying we're diverse is constructive. What I do think, though, is having a diversity of ethnic or racial or gender or business diversity is extremely helpful to have us make better decisions as stewards of capital. At the end of the day, I'm responsible to a diverse group of investors. Accordingly, I want a diverse group of thinkers and smart thought leaders on my board, on my team, to help me make the right decisions for my investors. It's just that simple. So what I think was an evolution has become a revolution. As it relates to why it's slow in SPACs particularly, I think it's just a reflection on what we're seeing in corporate America and corporate global. Again, historically, 10 years ago, people just didn't really think about it wrongly. Now they're recognizing with diversity of thought comes better output, better outcomes. And so that's how we approach it as well.
Thank you, Joe. This has been a great discussion, but before we leave, I want to make sure I ask you something else. As you know, there's been a lot of press lately on SPACs. So I'm curious.
Not all good.
Yeah, you said that. So if you had a crystal ball, where do you see the future of SPACs, like say in 1 or 2 years?
Well, I wish I had a crystal ball. It would make my job as a manager, as a manager of capital markedly easier. Let me tell you what I hope, or what I believe, that hopefully will reflect what I think it would if I had a crystal ball. The SPAC community right now reminds me so much of the VC and the PE community in the early to mid 80s. And the fact that I'm old enough to remember those days terrifies me. But it was a markedly different environment for those communities versus what we have today. Today, PE and VC have become extremely institutionalized. BlackRock, Blackstone, Ares, Apollo. On the private equity side, on the VC side, Sequoia, Silver Lake, it's Andreessen, et cetera. You've got a real institutionalization and a recognition by the investors of people that are institutional grade quality. I think you will see the same thing happen in SPACs, which is why SPACs that are populated in sponsors like ours with real talent, with people with men and women who have run businesses, who have made capital investment decisions, I do think it will evolve. A lot of folks and a lot of the press has been focused on what's the SEC going to do? How's that going to change? How will regulation change? You didn't mention in the introduction, 30 odd years ago, I started my career as a lawyer with the SEC, and I was ultimately special counsel for the division of Corp Fin, who actually reviews all the SPAC issuances and the de-SPACs. People forget that the SEC is a disclosure regulatory body, not a quality body. They don't regulate quality. The market will, though, regulate quality. So I think what's happening with the SEC, they're examining warrants, they're examining projections, they're examining multiple issuances. That's all good, and that will benefit people and firms like SilverBox, who treat this as a line of business, not a trade. And again, it all comes back to people in the seats. You need a talented group of people who operate ethically, who are all focused on the same goal. And in our case, that's finding and helping create and take to market world-class companies that are going to be in business for not just 1 year. They're not business plans, they're real businesses. So I think what the SEC is doing will be constructive. And I think the market will be even more critical of teams that aren't teams, or of people that don't have a team. So to me and to SilverBox, as a sponsor and a serial issuer of the SPAC product and a serial owner of multiple businesses, it all comes down to the quality of the people. So my crystal ball tells me I need to retain the best people that I have on my team. I need to broaden my team, bring in more people, and I need to continue to make good investments. The market will take care of people that don't do that. I can only worry about what I do with my team on behalf of my investors. And I will tell you, we're extremely focused only on doing great deals for the long run. So my crystal ball tells me this market will continue to institutionalize. You will continue to see teams that are successful, that treat it like a business, not like a trade, win more market share. And by the way, that's good for all of us. So again, I don't have a crystal ball, but if I did, that's what I hope I would see, because that's what I believe is going to happen.
Well, that was a great vision. I love it. Well, Joe, thank you so much for your insights. It has been extremely valuable for us, and I can't wait to see you in person soon.
Yes, and well, I'm tired of seeing people on Zoom, and I'm looking forward to seeing you as well. Thank you, Elizabeth, and thanks for having me today.